Hey, Kyle here with winthehouseyoulove.com. I hate to break it to you, but you cannot use whatever money you want for your down payment and closing costs. In fact, when you get a mortgage, anti-money laundering laws require that lenders verify any large deposits in your bank account. So for a lot of people, if they can't prove why they have a large deposit, which I'll explain here in a little bit, if they can't explain why there's a large amount of money that got deposited into their bank account, it can kill their loan and they won't be able to close on a home. So that cash that you've been saving, maybe under your mattress over a period of time, you likely can't use that to close on a home without this trick. So I'm going to show you a strategy, a plan that you can put in place that is both suggested and verified by mortgage underwriters that you can use to make it easy to use whatever money you want when you want to buy a home. Okay, so what ends up happening when you apply for a mortgage, a lender then needs to verify the amount of money you have with bank statements. And usually they ask for 2 months, 60 days worth of bank statements to see that you have that money to close. So the first thing that they need to verify is that you have the money. If it's going to cost you $15,000 total for down payment and closing costs to buy a home, they need to be able to see a bank account that has $15,000 at minimum in there. And they also need to see a 2-month history, a 60-day history of that bank statement to make sure it came from an acceptable source, which we will explain. So then what they're going to do is review the transaction statement, so your bank statement, and make sure it's not laundered or borrowed. So they're going to look through line by line and see if there are any large deposits into your account that they would either flag as, hey, maybe we need to look in this a little bit. And this would be called an unusual or a large deposit. So just an abnormal sum of money that comes in that's not your payroll that they need to check for. And the reason why they check for money laundering is because of the Patriot Act. After 9/11, the Patriot Act came in and basically said, if we have access to bank accounts, we're going to check to make sure that there's no money laundering activity happening. They also don't want the funds to be borrowed. So you can't just use a credit card for your down payment. Lenders don't allow you to do that. Now, one thing to note here is that the lender is going to be looking at your transactions in your bank statement, looking through that, seeing if there are any large deposits, which I'll explain loan by loan here in just a second. But your lender doesn't really care about what you're spending your money on. They don't care that I go to Chipotle pretty much every day. They don't care that you went to Speedway every other day. And sometimes it's funny, there's the loan officer here in our office where a client was like, you just want to see how much money I spent on sex toys. And it's like, well, I didn't, but now I'm curious. Your loan officer and your lender don't really care about what you're spending your money on. They want to see any large deposits that they need to ask questions about to be able to basically get a paper trail for them. Also, they want to make sure that the money that you have for your closing, for your down payment and closing costs, come from what's called an acceptable source. And I have a list for you here in just a second. So this is what the underwriter is doing. They're going to ask these 2 questions. First, when they're looking through a bank statement, is it an unusual or a large deposit? Which I have a list for here in just a moment. Then if it is, they're going to ask, is it from an acceptable source? Those are the 2 things that they're looking at here to see if they're going to question the deposit in your bank account. And if they question it, we need to be able to prove it with a paper trail. Otherwise, you will not be able to use those funds as your down payment or your closing costs. You'll have to find another way to come up with the money, or you will not be able to use that loan to close. So here is a chart based on the loan that you're using and what is considered a large deposit, because it changes between conventional FHA, VA, and USDA loans. So for Fannie Mae and Freddie Mac, which both are conventional types of loans, it says if a single deposit exceeds 50% of the total monthly qualifying income, then it has to be documented. So for conventional loans, if it's higher than 50% of the income that they're using on your loan, then it has to be documented. Okay. For FHA, recent individual deposits more than 1% of the property adjusted value, and the adjusted value explanation is here if you want to screenshot and look into that a little bit more. Basically just saying the purchase price minus any closing cost credits, or if the property value appraised is lower. VA doesn't have any guidelines on this, so just expect if you have any abnormal deposits that they're going to question. And then USDA says investigate all deposits on the account statements that are not attributed to wages or earnings. So with VA and USDA, expect a little bit more scrutiny. So then that brings us to the question, what is acceptable and what is unacceptable? So what is acceptable is commonly approved. That's often what I see gets through no problem. Unacceptable is commonly denied. Some lenders might have different things where they will approve those sources, but for most lenders, these are the ones that I see are commonly denied. So on the acceptable side, payroll, super easy. Payroll is usually never questioned. They can see your company name in there, and then that is perfectly fine as a deposit in your account. That's what most people have as large deposits, is their payroll. Another would be a gift from a relative. Okay, so if you got a gift from, let's say, your parents for the down payment, that's perfectly acceptable as long as it is documented according to your lender's standards. For some reason, it says ads in here. That's not part of this video. If you sell any stock, you can use that for a down payment or closing cost. Tax return, extremely common, and you can absolutely use that for your down payment and closing costs. Documented sale of a personal item. So let's say you sold your car. You can use the money that you got from that sale as long as the sale was documented. Money from the sale of a home. So if you just sold a home, you got a check for that. You can use that. Home equity line of credit. You can use that as well. Inheritance, settlement, 401k loan or withdrawal. You absolutely can use those for your down payment and closing costs. Those are acceptable sources of funds. So let's move on to what is unacceptable. The biggest one that catches most people is cash on hand. So if you have cash that you've been saving up, some of that kind of money that's been sitting under a mattress, or it's in a safe somewhere, or wherever you have it, most of the time you cannot use that cash. And I see people all the time, they want to take cash, deposit it into their bank account, but then the underwriter says, where did $5,000 come from? And they say, oh, I've just been saving it over the past few months or a couple of years or whatever. And the underwriter's like, you can't use that because they cannot source where it came from. You cannot source cash. Some lenders do have a way around this. However, most do not. So I wouldn't anticipate it. Another one is you cannot use credit card cash withdrawals. Sometimes I see people saying, like, if you can't afford down payment, just put it on a credit card. You can't. It's not a thing that you can do. It's not an acceptable source. Unsecured personal loans. So if you got a cash advance, you cannot use it. And then, of course, money for illegal activity. Shouldn't even have to say it, but if you're pulling a nose arc on us, you can't do that, unfortunately. Sorry. So here is your seasoning plan. Seasoning is just the word used for when we put money into a bank account and we let it sit there for a little bit, it becomes seasoned. Okay, so here is how this works. This is a 3-step plan. Number one is you're going to add money to your bank account. So in this situation, let's say we have $5,000 in cash. Okay, I can take that money, put it into my bank account today. Then I can wait at least 60 days. After that time period is up, the money has been seasoned. And so we will now be able to use transaction history statements and bank statements to then show only 60 days to the lender. Because most lenders only need 60 days worth of bank statements. And so we can pull together bank statements plus a transaction summary to show them a full 60 days, right? Because if we're in the middle of the month right now, we don't have a transaction, we don't have a bank statement for this month. So we need to pull the prior 60 days. All right, and that was where our large deposit was. We can actually use a bank statement plus a transaction history to make up those in-between bank statements to be able to show the 60 days without showing the deposit. One thing you want to keep in mind here is that the funds won't be questioned unless seen. So if you send a statement to an underwriter that has that cash deposit in there, even if it's older than 60 days, they're still allowed to question it and don't have to accept it as an acceptable source of your down payment and closing costs. So that is why we're using transaction statements and bank statements to piece together a full 60 days. And you can talk with this to your loan officer about this of how do I just show the 60 days? And they can help you figure that out with the dates of your closing and what day it is today. Okay, so this is what this looks like. Sometimes people get confused about bank statements and transaction history. So a transaction history is where you would go to your bank. You can usually do this online. So you can pull up your bank account online and usually print the history of what's going on in your bank account. You just want to make sure it still has all your bank account information, like your account number, your name, address, all of that listed on there. And then I blanked out some, because this is my transaction summary here, so I blanked out quite a bit. But this is what the lender would be looking at to be able to see the 60 days here. The bank statement is what you get once every month from your bank that would then tell you what happened just over that month period. So we would use these two documents to only show the 60 days. So just a quick recap of this plan. You can add basically any money here that you wouldn't normally be able to source wait 60 days, and then it is seasoned. Since it was already in your account and wasn't deposited in the most recent 60 days, and it wasn't seen by the underwriter, it is not questioned. The money that happened to be in your account before the 60-day period does not get questioned. However, within the 60-day period, it will get questioned if there's a large deposit in there. So if you want to learn more about what is the minimum down payment on a home, obviously you can pay whatever you want as a down payment. You can increase that. It's going to lower your monthly payment. But if you are curious about the minimum down payments of different types of loans, click on this video here to learn more.